And we have a bit of pressure on Fed Chairman Ben Bernanke as well. And apparently he threw in the towel yesterday, at least according to our next guest. Joining us to discuss what that might mean for the equity market is Diana Avigdor, portfolio manager and head of trading at Barometer Capital. Diana, you're chuckling already. So Ben Bernanke, he's in his corner. He's been beaten up. He says, no mass, no mass. What gives?
It was really funny this morning. A trader described it this way. Economy is doing well. No QE needed, good for stocks. Economy not doing well. Yes, QE, quantitative easing needed. Bad long-term, good short-term for stocks. Bad economy, no QE. That was the third option that Ben Bernanke gave us yesterday. And that's why the last half hour of yesterday was particularly different than other sell-offs that we've seen in the market in the last few weeks. It particularly felt like an air pocket as it was thudding down on almost just level, another level, and another level, another level as we were watching it stop at 1280. What possibly was a almost rally at 3 o'clock turned into quite a massive sell-off at the close.
Now, Diana, I didn't really see a whole lot new in that speech, to tell you the truth. Yes, the economy is slowing, but it is still growing. Monetary policy going to stay accommodative. Nobody expected him to say QE3 starts July 1, and nobody, in fact, I think wants QE3. So was it just an excuse to sell off into what is going to be probably a sloppy 2Q reporting period when it starts in 2 weeks?
I think people were surprised at the clarity with which he said there is a soft patch, and it was frustratingly slow growth. So the frustratingly word was not something that traders wanted to watch. And you know, we always speak that positioning and sentiment is what drives this market these days. Less, you get paid less for alpha, which by that I mean less for stock picking, and all stocks are exhibiting macro characteristics. We've spoken of correlations before. So, you know, with correlations have rallied. Equity correlations have gone up since the last time we spoke from 30 to about 58, 60. So all stocks exhibited macro tendencies. So everything dropped at the same time. At the index level as well as all stocks in the same way. So it was surprising the extent, the clarity with which he expressed himself. And you know, there is, we've been talking about the City Economic Surprise Index. That is at a level not seen since, actually the difference between that level and the S&P hasn't been that wide since 2008. So from an economic growth perspective, him saying frustratingly slow and looking at that index in the same context, it kind of matched up in a negative way.
Okay, we're looking at the index right now on our screen, and that is a remarkable gap there.
Yeah.
But what does that tell you? How quick an adjustment could we see for stock prices to come in line or to back to a historical norm, a normal relationship with the surprise index?
So one or the other has to do something. Either the economy is in a temporary soft patch, and that index that you see over there at the bottom will start moving up. Or the S&P needs to catch up. And what we've seen yesterday is the breakdown at the index level. Up until now, we spoke of rotation, and money has been rotating from a sector to sector, and you haven't seen the pain so much at the index level. Yesterday, something broke at the index level, so that's why it felt doubly bad.
So with the S&P 500, we'll use that as an indicator. You can use the TSX, either one. How much further down? That suggests we're in for a real struggle. That chart does. How much further down do you think traders, portfolio managers want to see before they start stepping back in?
Right. So 200-day moving average is probably where it's going to try and stop as a first step in the ladder. And the TSX is not that far away. There is maybe less than 1%, I think, to its 200-day, because the TSX has gotten hurt a lot more than the S&P in the last few weeks, given its commodity exposure. So that'll be our first level to watch. It's also going to be interesting to see whether in the next few days the market sentiment has been, as measured by the VIX and SKEW, has been extremely benign implying A, either that people are overhedged, or B, are not worried. I don't think they're not worried, so we'll see if the volatility components of what we're watching are going to increase going forward. And if they do, and there is some kind of sell-off climax, and the indices reach their 200-day, then we may possibly pause there. I might also add as a silver lining that India and China are at extreme oversold conditions. Maybe we stop there as well. So
All right,
close,
Dan.
but not yet. So like we said last time, build your farm team, your stocks that you like to watch, that if you need to come in, get in the market quickly. But for now, just watch, and better risk-adjusted entry points are probably coming up.
All right, great to hear from you this morning, Diana. Thanks for your
Thank you.
thoughts. Diana Avigdor, Portfolio Manager and Head of Trading at Barometer Capital.